economic indicators can be pro-cyclical, counter-cyclical, and acyclical. Pro-cyclical means they move in the same direction as the economy goes. If economy goes in this direction, these indicators go in the same direction. If it is positive, it is positive. If it goes negative, this will also go negative. For example, GDP. If you see GDP is positive, that means economy is also growing positively. Counter-cyclical is if this is going in one direction, this will go opposite direction. For example, if you see economy is growing positively, you will see that unemployment rate is reducing. Okay, because economy is good, unemployment kam ho jayega. Unemployment will reduce. So these are like counter-cyclical. If I see that unemployment is reducing, I can very well say that economy is growing. And acyclical is something which has no relation. These indicators are independent. It has nothing to do with the economy. Something like government loans, fiscal balances, all these things have nothing to do with the economic growth. If government debts are high or low, the growth doesn't get impacted. Government debt, what happens is, if government debt increases or reduces, how does it matter? See, sometimes government borrows money just to take care of the excess liquidity. It is not that government needs money. Okay. RBI will issue the bonds not just because government needs money. RBI may just issue the bonds in order to reduce the liquidity from the market. So there are certain measures where government debt increases doesn't mean that economy is bad or economy is going good. Fine. Today, because of the pandemic, because of this current situation, there are certain measures that has been taken. Doesn't mean that it holds good every time. Government debt. Government debt means what? Government issuing bonds. Okay, government is raising money from public. Why would they raise money from public? They would raise money from public because they feel that government has the public has excess liquidity. So in order to come up to remove the liquidity and in order to control the inflations also, they might have to issue the bonds, and their books of the debt will increase. Now generally debt is a little negative thing. Okay, a debt is a little negative thing, that if debt government is under a lot of debt, they have lot of money borrowed, that means economy is going bad. Rather, in this situation, government is rather issuing the bonds in order to control the inflation. It is nothing to do where the GDP may go up or come down. It is just to control the inflation. Okay. So likewise, all these things, a few of these things are acyclical, which are independent, may not have a major impact in the economy and understanding the direction of the economy. The regulatory structure in India. We have different regulators in India who are regulating different products, different segments and instruments. Starting with, or let us understand what are the products which needs regulation. You have the banking products, which includes your loans and fixed deposits and all. Then you have the stocks, mutual funds, you may have derivatives, you may have real estate, you have insurances, you have retirement products. There are so many different products that you would end up investing, commodities. So in order to control the banking products, you have RBI as regulator. In order to take care of the derivatives and stocks, mutual funds, you have SEBI. In order to take care of real estate, although real estate ke liye there is no much major regulator as such, but of late you must have heard about RERA, which has put certain regulations, certain restrictions and control. You have IRDA, which is taking care of insurance. You have PFRDA, which is taking care of the retirement products. Okay, so why these regulators are required and how it is going to impact your investments or portfolio? Without the involvement of the regulators, people would not even believe and invest the money into the markets. Nobody would invest into the bank's fixed deposit. Nobody would like to buy shares. Nobody would like to invest in mutual funds because there is no, see, regulators are going to give you an assurity that your money is not going to be mishandled, and we are vigilant. We are going to monitor the activity of these guys, and if we find that if anything is wrong, we will disqualify them, we will suspend them, we will remove them from operating their business, and our money is going to be little safe. So there will be a regulator's role is very, very important. And wherever you have regulator, there will be lot of liquidity, there will be lot of assurity of settlements. But wherever there is no regulator, then your investments will carry a little higher risk than the usual. In real estate, there was no particular regulator. So what happens is, you must have heard lot of litigations in real estate. Litigations you must have not heard in fixed deposits or banking products, mutual funds and all, but litigation is more involved into real estate because there is no proper regulator. Okay, so regulators' role is very, very important, and you need to understand who are the regulators, what is their function, and what they are controlling.
Reach out today and let's do it professionally.